Hopefully those issues resolved themselves last night after all that updating. Mm.
The situation that Don is talking about. Can it effectively do that? It's not clear. Disclosure's not great in that area. So another area where it might be helpful to have more robust discussions around that to give more confidence to more participants that actually could work.
And that's about resolution. So you're in a situation where you're managing a failure. So it'd be nice to prevent the failure in the first place.
Ben, did you have a remark on that?
My only observation is I did refer to reducing fragility, and that's part of the benefit of potentially having greater flexibility. I mean, implicit in that reference to fragility is the possibility that the point of non-viability is higher in 2015 than it was in 2008. So that's, again, a reason why I think it's beneficial to consider the capital framework alongside the resolution framework.
Wow, very complex topic. Don, I want to turn last to you, and you have been an advocate for reducing the SLR in order to make sure that it remains a backstop, as we've discussed, and doesn't impede
I was looking at the stream last night.
Treasuries, as we've also
Was the
discussed.
mic?
But
Was it making
you've also
static
noted an important
noise
caveat
last
that any
night?
adjustment does not reduce resiliency of the banking system.
Man,
so
I got out of this gold play too soon.
How does it stack up against?
Man, I got out of this gold play too
freaking
freaking soon, man.
Thank you, Daryl, and thank you
I got out
for
of
inviting me to be part of this panel to the vice chair. So you're right.
Too
I've
damn
long
soon I got
supported
out of it, man.
enhancing Treasury market liquidity by making the leverage, the SLR, a backstop. In fact, a senior Federal Reserve official told me a couple of years ago I
believe
using
I may have
too much
fixed
of my brain space on the leverage ratio. So I'm grateful to have that space freed up for something
hopefully
else.
that little static
But as
noise
you
was not
noted, my support has been couched in the
Dude, I
context
freaking
that
knew it
not
was
reduce
coming, man.
overall
I knew it
capital
was coming. We
requirements and
talked about that
resiliency.
shit.
And I think I take quite a bit of comfort from the fact that there's no
It's still doing that?
reduction in the holding company level. But I do think, as I just noted, there are things we need to think about. And I still have a few concerns on this overall resiliency issue that I'd like to surface and I hope come up in agencies' consideration. First, obviously, making the SLR a backstop puts extra pressure on sound risk-based capital requirements. And I think financial sector resilience is especially important right now. The economy could well be on track for good growth and low inflation. That's what's priced into financial markets.
I don't know.
But we shouldn't be lured into complacency. Secretary Bessent last night worried about pro-cyclicality in financial markets. He cited private credit in that regard. But we know banks and bank regulators, from history, we know banks and bank regulators are not immune to this particular disease. And the tails of the distributions around the central tendency seem unusually fat as we are in uncharted waters with respect to the evolution of the global trading system, the ratio of federal debt
does it
to
sound
national
any different
income,
than what it did, or
challenges to the
did it get
independence of
better?
the Fed.
Did it get
So I
worse?
think the
How does the
risk of
audio sound?
unanticipated developments are particularly high right now. And it would be preferable to evaluate this proposal as part of a holistic review of all capital requirements. In that respect, this is a terrific conference putting all this together. There's so many in the risk-based capital. There's the Basel III Endgame GSIB requirements and the stress tests, and how are they all going to fit into this? So we're risk-based capital requirements.
But I kind of figured that my funded futures was going to change
I need to rethink my
their rules.
for
I mean, it just, for whatever reason, it just,
reducing
their
the
behavior just
backstop,
kind
and
of,
I urge the agencies to put the whole package together before signing off and in one piece. And the second point, I want to come back to something that came up before, and that is Releasing capital at the DI will not reduce the resilience of the overall organization, but you will be encouraging. In fact, one of the benefits cited in the thing is encouraging banks to buy treasury
So Powell was supposed to be talking
so
at this
it does
thing.
expose them to
He doesn't look like he's even on the
risk,
board.
widespread losses on Treasury and agency securities contribute not only SVB's problems, but the risk to the broader system that triggered extraordinary actions by the authorities in March of 23.
I'm actually going to look that up.
Banks should
So
be
Investors East said that I'm actually going to look that up now. Like I said, for whatever reason, I don't necessarily care for my funded futures after they took away
the subject to market risk capital requirements.
after they took away all the starter accounts. Those, in my opinion, was the best accounts. I really enjoyed those accounts.
Close scrutiny, and as I noted, my
The
concern
only
about
account that I
interest
trade
rate
from
risk
them because it's the only account that really
would
makes
make me
sense
very
in my
reluctant, would
opinion.
make me opposed to exempting all treasuries from the leverage ratio.
I feel like it was a perfect
the
balance
gist of your
of
remark is that you want to see the
the
whole
best way to
package
get a
before
payout.
a final view on it.
They scaled you to protect you.
Interesting. And other, Hal, what's your view on this?
So I think we need to keep in mind
500
that the US
extra
banking
dollars of
system
drawdown.
is
It was
today
a
very well capitalized.
it's a really good
US GSIB actual capital levels have increased
platform. I mean, it's a really good
17%
program, and
over
then
the past 2 years. And
it
our
seems
minimum
like
capital
now they're trying to
requirements are
focus on
now
their other programs
1.7
and trying
times
to
higher
decommission that
than the
one.
Basel
At least
requirements.
that's what it appears like to me.
837 billion versus 473 billion
Excuse me.
under Basel because of our stress testing regime and gold plating. Keep in mind that we gold plate the Basel requirements. This proposal does not reduce risk-based capital. It merely moves leverage into the background where it always has belonged, and in my view, we could do away with, okay? And if it's in the background, you can further say, why do we need it then? If it's now in the background, it's not binding anybody.
Just did the
Okay,
same
so
thing that
anyway, I don't.
Tradify is
I think
doing.
overall, the U.S. banking system is in a very good place today in terms of its actual capital levels.
Let's look at that.
Hal, you mentioned gold plating. I'd like to get
So,
a reaction
they have
to
new
something
plans.
that came up, another topic that came up at dinner last night.
They said
which
this same
is
crap
the implications of the SLR and other
did, and then they canceled those
regulations
damn
on
things.
the ability of U.S. banks to compete both with non-bank financial institutions
Split. Yeah, I'm
and
done with my funded
international
futures, man.
banking institutions.
If the
First,
starter plan is still the same, that's the only
competitive
account that I
angle,
trade.
Does it figure
They're expensive.
in your minds as an important aspect of the rule change? And secondly, is it actually true
80-20 split thing, that's
that U.S. banks have been at or GSIBs have been at a competitive disadvantage
no
because
micro
of,
scalping rule.
the capital requirements that we've been
Says no,
discussing?
the legacy plan starter plus
quite
expert
frankly,
will be
don't know the
available
answer to that, but I
for
would be
some
skeptical.
time
I
to
think there are a
purchase.
lot of
Wow.
other factors that affect competitiveness. I mean, you know,
Already
when
said
we
it. I just knew this
originally
shit was coming.
adopted Basel, it was because
How
of,
often do we predict
competitiveness
the business
concerns with the
plans of
Japanese
all
banks,
these
right?
prop firms before
And
they
we said,
drop
well,
it?
get them
We
on an even playing
always
level, they'll have to have
predict
the same
what these
capital
prop
levels we
firms are
do.
going to do.
But then it turns out they have different accounting systems. They have
I
different
was talking
government
about this for a while,
subsidies,
and here
they
it
have different
is.
forms of
And this was my
regulation
biggest
that have
concern because
nothing
I
to
was
do
like,
with
dude,
capital.
they're
So you have
getting
to
they're
add
getting
all
rid
of
of this.
that into the picture
And
when you're thinking about
here we are.
competitiveness.
So moving
Any other
forward,
reactions on
I don't know,
competitiveness?
man. I'm not going to purchase any of these accounts.
Ryan.
So
I would
my
say
funded futures
certainly
is no
we have
longer
a
an
higher
option for me.
SLR requirement than other jurisdictions, although that does not seem to have stopped our banks from competing very well against a lot of the international banks. I think certainly non-bank financials have significantly increased their scale and scope in some of these businesses, and obviously they don't have the same regulations, so that might have merit.
Is it? And moderators don't get to vent their
Yeah.
own views, but it does seem like better
I
capitalized
mean, I
banks
get
are
it,
better able to compete
but
in principle.
Yeah, that was the point I was going to make. I don't think the UK, European,
I mean-
Japanese banks would think that they're at an advantage because their capital hasn't been gold.
be cute with these plans. Apex makes
pretty
or
much
at least reportedly makes $20 million a
competing
fucking
very,
month.
very well
And they have the
in
cheapest plans like out there out of
international
everybody.
field.
They
And
have
there
not
are,
adjusted their plans at all.
times when
They're always
being
doing deals. Their
well-capitalized,
biggest deal is a
having
90%
high
off.
capital is to your
It's
advantage because, of course, under stress, there's much less to
understand
worry
why these
about.
firms are
We
trying
saw that
to
in the U.S. in the March 23
get more money.
situation where
Even
deposits
with all
fled
the
from
even with all this
regional banks where people were
even with
concerned
everything
about
that Apex
embedded
goes through
losses
in terms
on
of
treasuries and other
people not
things,
being paid
and
out or
they
all
fled
the
to
drama that
G-SIBs.
goes
And
on over there with
some of the
Apex.
commentary, well, that's because the
No
G-SIBs
one
are too
seems
big
to
to
have
fail.
the
But
same
I think
success as Apex. I really
it
don't
was
understand
also
why people just
because
don't
the G-SIBs were much better
offer something
capitalized
similar
and much
instead of
less
trying to play with
likely
the
to fail.
prices. You're not going to change.
Okay.
I'll make one observation, which
Yes,
is
go
that
ahead, Ben.
you receive a lot of questions about
Well, this is
the
what I believe is
regulatory
going
capital or
on.
liquidity
I believe
treatment about
that
particular transactions or products and things of that nature. And that does clearly illustrate that they're marginal incentives
apology.
and essentially what the marginal capital
They
cost, liquidity cost
consult
does
quote
factor in.
unquote
That's not necessarily
experts,
contradictory.
people
but I think it
that
does show
don't
that
have
that
friends
actual
in their real
marginal
life,
effects of
but
regulation do factor
they can
into
only
business decisions.
theorize how
And there are
people
differences between U.S. and
behave.
non-U.S. requirements.
Tiffany, at a global bank.
Firms consult these people
Well,
and they make decisions.
To re-highlight some of Don's points.
People that deal with
One
other
being
people can see it
completely
for what it
support
is.
interest rate
Especially
risk management.
people
It's a
that
strong
work
pillar.
in
It's
a
an
corporate
important
setting,
risk pillar,
and
and
their
as I mentioned, it's
job
an
is to
important,
deal with the
part of
different
the
energies, the different
overall risk management
personalities that
framework for
people come
banks.
with.
Second, the
So
holistic
when
review,
I
think
see
is an
these things, because
important
that's what
point
I
as well,
deal with,
because we find
I
that,
can already
again,
see
managing to a lot of risk measures, making
why
a
they're
change
trying to do
to
it
one risk
and
measure
why it's
is
going to
likely going
succeed
to
or
have
fail.
another become binding over time and could have the same constraints, let's say, on the treasury
to
market.
hang yourself with.
So I think that holistic review is
And
also
that's all
makes a
they
lot of sense.
ever needed to do.
Terrific.
Because
Okay, I think we got a pretty good
deep
sense
down,
of the
when you
views
fill
of
an
the
Apex
panel. I think
account,
it's
you can say it
time
was
to
the
turn to
intraday,
you all.
the intra trailing drawdown,
If
whatever the
you
crap. You can say
have
whatever
a
you want.
question,
But
would you raise a hand? I see there are microphones. Would you
and
also
internally,
please
you think it's your
identify
fault.
yourself and
And
try to
when
keep it
you're
to a
in that
question,
tilted
just
state,
one. If we have a
you're going
second
to want
round,
to
we
say,
can
you
come
know
back.
what?
And
I
not a
felt
speech, just
cheated.
a
I want to
question,
get back
please.
into the market. They provide cheap resets.
Is this-
They provide an
my
easy
name's
barrier
Corey
for
Zhang.
you
I'm a
to
SIFMA.
be exactly
My question
who.
is, as you know, currently category
Make-
1,
that's
2,
why they're so
3 banks
successful.
are subject to 2 leverage ratios.
Because before you know it,
one is supplementary leverage
you
ratio.
spent
the other one
$2,000
is tier 1 leverage
and you
ratio.
only passed
And the
maybe
question
1 or
is,
2 accounts. I mean, that's why
why
their
do you
model
think
works. They just
2
give you the rope to
ratios,
hang yourself with.
both
These
target
other firms are trying to be
leverage are
cute
needed
with
for
it.
these banks.
They're trying to maximize profit, but at the same time, not really give
Okay,
you
I'm going
anything in
to,
return. Did I get stopped out? I got
I'm going
stopped
to
out.
ask
Okay.
anyone that can
I got
address that
stopped out at this
question
play.
because I don't want to handle that one. Hal, do you
And
have a
that's the
thought on
game that these guys are
I'm
playing,
not
and
going
they're going to
one or
fail.
two ratios. but I
They're already
disagree with
sharing
both of
market
them.
share with everybody. They're trying to get more revenue. I feel like these
Okay.
companies are behaving like they
I'm watching for hands. Yes.
show growth every year.
Hi,
Sharon.
Sharon.
I feel like that's how. I mean, I feel like that's what they're trying to do. But
you mentioned that you think
Apex
that
has
we should
already
have a
set a standard
countercyclical
of
buffer.
of
You mentioned
of
overlap
pricing.
between different parts of the capital regime.
You can kind of,
You mentioned that it was something that
but
made
you're
sense
not
in
going to
the
get people
UK,
to
but at the same time,
fail
the
a
US has a
$300
much
account
different capital regime,
and turn around
inclusive
and
of
buy another
the CCAR test, for
$300 account.
example, which
It's
does give
easier to
you
buy
an
a
ability to build
$50 account.
capital to be there for stress. And so
It's
I'm
easier to do that,
curious
especially
as
when
to
you're
why
tilted.
you would
But
want
if you're
to
tilted, it's like, oh
impair
shit, I just blew my
potential
account, but
use of
I'm not spending
capital from
$500.
banking institutions in a period of stress.
Firms
where they
believe
could
that you
be
will,
using it to
because some
lend
people
and
do
still
it,
put
but
on an
majority of
additional
people are not.
countercyclical buffer on top of that.
I'm well
So
off, and
it's almost
I could
as though
afford to do
the-
that, but
the
I'm not going to do it.
concept behind
But
having overlap
$50,
is not
$50,
necessarily taken into
$60
account from a buffer mentality where you don't necessarily have the CCAR exam in the UK.
Yeah, so I certainly
Usually-
think there's simplification
I mean,
and
let's look
the
at these
two
plans.
leverage
So,
ratios and
I guess these
overlap
core
between
prices,
things.
so it's
That's why this
$66,
is such a great
zero
event
activate.
today, because the authorities can hear views about how these things interact and whatnot. But I do
Core,
think my
scale,
countercyclical buffer thought, or at least the way we exercised it in the UK, was exactly to free up capital in a stress event And by lowering the by taking out the counter-cyclical part, you enabled banks to use that capital without running into
They
restrictions
put a 50% consistency rule on evals,
kind of thing. So our
$77
view,
for
and I
core
think,
plan before
as
promo,
I've read the studies
which is not
that came
bad. I guess
out
that's
of
not bad.
the
$77
March
is not bad.
2020
Tiered
COVID
payout
thing,
caps on
that
scale,
for
80-20 split.
countries in Europe
So
that
with
had
these,
counter-cyclical buffers,
with these 80-20
they found
splits,
that it did, the ones that released
the way
those
that they're
buffers had
engineering
better
these
lending
accounts
experiences
now,
than the ones that didn't. So the whole, maybe I
like
didn't
what,
understand quite your
$1,000,
question
you're only going to
totally, but
get
the whole point of
$80
the
out of that.
counter-cyclical buffer is to encourage
And then
lending
my funded
in
future
stress
also has on
situations
top
or
of that, but I don't know
discourage
if they're going
having
to,
a constriction of credit
I don't
add
know
to a stress situation.
if they're going to combine it, because they actually have it
Alistair.
to where
Oh, sorry.
if you make
Yes,
over
you. Thank you.
$10,000, then they automatically do like, what is it?
Just an observation. This entire
They automatically kind of, what is it? The 80, it goes from 90 to 80, I think,
pointing to the function,
or it goes from 100% to 90%.
What we're actually talking about is the ability of
$1,000
$1,000
payout
to increase
scale.
their
Does
balance
that
sheet
get
in
added
times of
onto it?
stress. So the
You get
noise
70%?
around, hey, banks are just going to go buy more themselves up because they can take more interest rate. We're not going to buy any more treasuries. We can get duration 100 different
20
ways
flat
without
profit
going to the
split, so
treasury
maybe they're doing
market.
away
We can
with
do it
that.
off balance sheet
New
through
trading,
swaps.
news
What we're
trading is
simply
allowed.
talking about is it a good idea to give GSIBs
So they
the
increased,
ability to grow their
they
prime
increased it to
brokerage
5
operation
accounts.
to support
So
the
it seems like a
actual
lot of these firms now
capital
are making it
providers
to the
into
point to
treasury
where
market today, which are principally hedge
if you
funds.
want to get a decent payout, you
And
have
by the
to
way, I am
copy
in favor
trade.
of that, but I would
Like they're
reduce the
capping
conversation
the
to that
amount of
because
money
I
that
think
each
our issue
account
ultimately
can
becomes the size
produce.
of prime brokerage.
So it forces you to
across Wall
buy
Street as
more
opposed to what the
accounts, and
leverage
that's
ratio
the goal. It just, they just want
Bill,
you
would
to copy
would the
trade
support for
multiple accounts
for hedge
because
funds and others through prime brokerage increase in a stress? So I think one risk, isn't it, that
Tradeify does that too. So it looks like my funded
this
futures kind of
actually
taking a page from
enables
Tradeify.
the hedge funds to become more levered
Yes.
because banks, and
I don't know.
now
And that
you've got a
that
stress
80
hits,
split,
and
it forces you to
margins
trade
start
more.
increasing,
So
and the
you're
pressure on the
picking-
hedge funds, the basis trade blows up even worse.
You're picking your
It forces
poison,
you to
but that
trade
is the
even more,
correct
and I don't like
discussion.
that.
So banks, since I worked on a primary dealer desk 30 years ago, they don't take down the auctions anymore. Right? We used to. We no longer.
You can trade news with
hedge
my
funds
funded
bid the
futures.
auctions, we
It's just
the big banks finance the auctions. If
you
get
couldn't
an
trade the
off-the-run
tier
treasury
one
that won't
news.
trade because it's unfinanceable,
You couldn't trade
disruption
that.
and dislocation. So you want to be able to finance it. You say, all right, well, I
But
want the
all
treasury
other news
market
you were able to
function 'cause
trade.
We're running the biggest deficit we
So-
ever had, and it's likely to grow. So
All trades
therefore,
and
I
stuff
need
like
to get
that.
capacity to make this thing work. I need to expand primary deal, the prime brokerage, central clearing, a whole bunch of other things.
But
to
like I
allow
said, if
that
they
to
get rid of the,
happen,
oh my
all of which
God.
I'm
Oh
in
my
favor
fucking
for, but
God,
I'm
bro. God
simply
damn.
saying that we're consciously choosing to ask banks to finance a larger portion of the principal positions of the players in the treasury markets. That's what this rule is about.
Yes, Pete, a question right here.
I have a follow-up actually to Bill's observation.
Could you give your,
Sure.
your name, Pete?
Peter Blostein, PB Investment Partners. So a follow-up to Bill's question is perhaps
I made $1,100
which is to
earlier today
ask,
with gold.
Are there other
I took profits too damn
rules that should
soon with
be
gold
addressed
in
if
this
we're trying to
account.
get more treasury
I took
market
profits
liquidity,
at
namely,
14
proprietary
or
trading and Volcker
14.
rule? Should banks
Yeah, I
rebuild
took profits at 14, and this shit
relative value
kept on
fixed income
got
desks
kept
that
on.
all migrated out of the banks post Dodd-Frank, post
Damn, look
Volcker,
at that, man.
and that should be the place for treasury
at that
market intermediation rather than hedge funds, as Bill suggests. Just an off-the-run thought. Thank you. I'm curious if any panelists support that view.
Any of
You
you
said
panelists?
trade day. It said it's Apex without the.
Well, I think in the context of looking at and taking a look at regulations overall, it's an important holistic piece of, the discussion today. I do think in the context
Yeah, I
of,
think so too.
intermediation is one piece of the Treasury market. Certainly that is a very
And I
important
definitely agree with that,
activity during a period of stress. But to
Alfred.
the point of
Everybody has their own
close to 30 trillion market today, growing.
trade day,
Intermediaries
and
are one
Take
player in
Profit
that
Trader
market.
is on my
Buyers
do
and
not trade
holders
list.
across
I really
all different banks
do not see
is
myself
something that we
ever
need
trading with
to
those
and should
firms, but
consider to
you and
continue to
Investor
support
Z,
that market. So that's the
I think
kind of
very
broad
highly
view,
of those
and
firms.
looking at broadly regulations overall
So that
is,
just goes to
I think
show
certainly
that,
the leverage ratio is a
yep,
step in
we
the right
all have a
direction,
difference of
but taking that
opinions,
big
and
picture view is
nobody
part
is
of that
right or
holistic
wrong.
discussion that we're having here today as well.
Subject to market risk capital.
It's just basically
Market
what
risk,
firm
interest rate risk
best
management.
aligned with
Interest
your
rate risk
personality
management.
and what goals that you want to achieve.
The
I will say that with
The
Apex,
proposal does
even
cite
though I
some
haven't,
research, for example, by Falk Breining and Hillary Stein at the Federal
I'm
Reserve
getting
Bank
to a
of
point to where
Boston,
I think
showing that those
my
dealers that were
trading style will
relatively
be
more constrained
more aligned
by
with what Apex is looking
SLR
for,
provided relatively less
and I'll be
liquidity
able to
to
take
Treasury
a
markets
payout
in the
from
March
them.
2020 event. And more recently,
But
a Federal
as I
Reserve
stated
Board
last night,
study by
I use
Mary Tian
Apex more
and her
for
co-authors showed that those banks that have
for
more headroom
practice.
under the supplementary leverage ratio provided more financing, to Bill's point,
An
in the
Apex
Treasury
account.
market.
It's
So
to kind of
there is
practice
some
on Apex.
research in support of what you're all saying.
All right, so I'm in this trade right
other-
here.
Daryl?
Yes,
Let's
Hal.
see if it's going to work out.
So I understood the question basically was, let's get rid
Oh
of the
shit!
Volcker
I just
rules so we can
realized
have
that
more
I missed the
prop
orb.
trading
Oh
that
my
could
god!
actually
I just
help the
realized I
Treasury
missed it.
market. Fine.
Fuck!
It's the implication. Okay.
I just realized I
Okay.
missed the orb.
So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected in Massachusetts.
I missed the orb. Oh my
So
god! I can't
remember the
believe that
Senate
shit. I
hearing
missed the
on
orb.
this and the Democrats being
I
puzzled
wasn't paying
about
attention. It's
why
talking
we were
about
even
my
doing
funded
this.
futures and shit.
If
Minding
prop
other
trading
people's
would help the
business instead
Treasury
of minding
market,
my
I would
own.
be in favor of
And I
re-examining
missed
the
the
Volcker
trade.
rule. But I want to caution everyone as we talk about all these changes, there is legislation to consider here. This is not something that the Fed or other regulators can easily do on their own. A lot of these changes are embedded in statutes, okay? Now, maybe the president can be creative with executive orders in this area, but as we proceed on this line, we have to ask ourselves, how much can the regulators do without legislative change? And that's a big constraint, okay, in this picture.
Just to be clear, in the legislation, the Treasury market is exempted from the Volcker rule, so it doesn't really restrict proprietary trading in the Treasury market. So let's have another question.
Daryl.
That's not true? Treasury securities are not exempted from the Volcker rule? I think they are. Al?
Well, it appears that Powell is
Daryl.
not on this board,
Sorry.
so I don't think we
over
need
to-
to watch this. He said, but Powell's not on the board, so. Hmm. Yep. Yeah. I definitely would agree with that, Alfred. I definitely had some bad habits that I had to unlearn. Oh shit. I missed an opportunity here on the Nasdaq. See if I can let's see if I can kind of make up for it. I missed 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 it. Goodness. Not only did I miss the orb, did I miss the follow-up trade for the long. I wanted to actually get in at 130. So, I mean, this is a bad entry. This is definitely a bad entry right here. I wanted to get in at 130. Okay. Was you? All right, let's see. So far, so good. But like I said, I apologize. I missed the damn I missed the entry at 130. Damn, ES, you worked real hard to stop me out. What was up with that? God damn. She worked really hard to do that shit. Hey, what's up, Santiago? Congratulations on that. Santiago said that he got in at 279 and rolled this thing all the way down. Congratulations. Yeah, we was talking about my funded futures and I straight up missed. I straight up missed the goddamn orb. It's my fault. Ah, shit, yo, what the fuck? They actually. Oh. Oh, did I hit daily loss limit? I think I hit daily loss limit. Okay. Damn account. I really don't know. Well, this is what I guess I really didn't want to pass this account because I didn't really want to pass it. Then for whatever reason, I did not have any winning trades in that account. None. I guess I really didn't want to pass it. I kind of wanted to save it for next month. I wanted to get as many of these accounts passed, and that's a 9K account, and I kind of wanted to either pass it this week or anyway. So it looks like all they did was just rename. So it looks like they renamed everything core. So I guess the core selling 5-1. Oh my God, bro. 5-1. Really? Okay. I deal with that. can't deal with that, man. Hmm. Hold on, guys. Let me see. Let me try to let me change the mic. Let me change it. Give me a second. Mm. That's great. Testing, testing, testing. Oh, is it still doing it? Oh crap, maybe. Hold on. How does that sound? Is it still staticking and stuff like that? Just let me know if it's still staticking. What is it at 9 o'clock? Let's see. I just swapped out my. I don't know. Maybe I should. I don't know. Hopefully that did it. All right, so it's still staticking. Mm. might gain. Okay, let me look at this. So what do y'all guys hear static when I'm not speaking, or does the static only come when I am speaking? So it's both. Okay. Mm. When not speaking. Mm. Uh, did y'all just hear that static just now? Did a static just come through just now? Because I'm looking at the mic, and for whatever reason, it's picking up. Okay, all right, I see it. So the mic is picking something up. Yeah, I don't know what the heck is up with that. It's picking something up. No, I didn't do anything. Just went on vacation, and all of a sudden, I testing. Is it doing the static noise now? Did it just do it? So it's picking static up. Maybe. Okay. Yeah. Okay. So it's okay. So it's the mic. It has to be something. Are you talking about right now, or are you talking about like sometime in the future? Shit, if you're in the Discord, I guess we can all do we can do that. We can all get on a call. I definitely would have to set time. I would have to actually just create time, move things around. Because shit, after I get off stream, I'm extremely busy. Yes. That's just frustrating. Okay. Because I see that thing, it just, I see it's picking something up. I don't know why it's picking that up, but it's picking something up. Testing, testing. Yeah, the audio might sound a little bit off. I turned off all the filters. Because what I want to see is if it's the filters, if it's one of these filters that's doing it or picking it up, or if it's just the microphone itself. Okay, it just did it now. So apparently it's not the mic and it's not the filters. It's something that's getting picked up. I don't know. At this point, I really don't know. I apologize, guys. I really do. It's not any of the filters because it just did it. And I appreciate that, Santiago. I'm really gonna have to look at that. Man, I feel like I don't know, man. Am I being tested right now? All right, what time is it? 9:20. Well, it said that Powell is supposed to be speaking at this thing, but he wasn't at the board, or he wasn't on. He wasn't at the board.
Promoting trade in financial services. So, large global banks have economies of scale and
Of
scope, and
course.
part of the way they get those is having similar rules across borders. So it's what allows domestic banks to operate abroad and foreign banks to operate domestically. So that's the general. What about the specific on Basel Endgame? So, as Rob said, our version of that is called Basel 3.1. So we couldn't quite bring ourselves to call it Basel 4, and so we had like a tiny eeny weeny Basel 3.1. But my guess is we were looking for the same kind of comfort blanket that you guys were when you called it Basel Endgame. It's part of the post GFC reform package, so it's the
So you're trying to
third
say it's my fault? Gain
first
weight.
two bits were about the quantum of
The
capital.
market didn't even hit my limits yesterday, which
So
was upsetting.
quantum we've done already. So I don't think that the Basel Endgame package needs to be about the quantum of capital at all. What is it about? It's about measuring risk better, right? So the standardized approach we have at the moment, the standardized approach is always going to be blunt, but it's just very blunt, the one we have at the moment. And so we're kind of tilting it just better for the right activities. And that is important in its own right, but it also has benefits for competition, because one of the things that we feel strongly in the UK is that smaller banks have been unable to compete on low risk activities because they're forced up the risk curve by this very blunt standardized approach. And so on the
Yeah,
model
I
risk weight
guess.
side, we kind of lost confidence in that a bit. So we had these papers post-crisis where we were running experiments. We gave firms the same, exactly the same scenario, run it through your models, and they throw out completely different risk weights. And that kind of drains confidence. So one of the things we're doing in this endgame package 3.1 thing is a bunch of things to try and bring back some of that confidence again, so through things like the output floor. So I'd argue there's a lot to like about international standards in general because they give us benefits, but this particular package is balanced and gives us some good things.
All right. Well, thank you very much. As everyone in this room
So we're
knows,
testing
this
on
is not the
NQ.
first time we've taken a run at Basel Endgame. So I'd like to ask Randy to start off and give us a sense of what were the mistakes that regulators have made in the past? What are things that should be avoided now as they craft this again?
Well, I guess it depends on when in the past you're talking about. because there have been a few efforts and some were better than others, as it turns out. But so I think there are, with respect to what ought to happen in finishing the implementation of Basel III, I think there are substantive issues and there are process issues. The first substantive issue is that these measures, even in Basel, as Phil mentioned, this isn't about the quantum of capital, and it was not about the quantum of capital when these measures were being discussed in Basel. It's about the incentives that the overall capital framework is creating, and they were not intended to increase the quantum of capital, and I think that should be a first principle of implementation here in the United States. Not just because it's sensible, it's also Basel compliant. It's not intended to increase the aggregate amount of capital in the system. I think, and there have been proposals around implementing Basel III that would have done that, and I think that I think that was the wrong direction. As a matter of process, I think it is a mistake not to get as much input as possible. And so this conference is a paradigmatic example of how one ought to go about the process of the implementation of these last measures of Basel III. From all sorts of areas. More heads are better than one. I think there have been folks who have said, look, here's a proposal. If you don't like it, vote no. And that's, it is a better process to have gotten input from everybody in this room, folks outside of this room, academics, banks, public interest. I think banks are part of the public interest, but a wide range of groups. And I think if you combine those basic principles, then there can be a successful result. I would add that I do think there should be a successful result. I've heard, there have been threads over the course of the last several months that maybe we just drop these last measures of Basel. And I think that's not in the interest of the United States. Phil makes a good case for, global financial stability. I used to be a global financial stability guy. I have nothing against global financial stability, per se. But the Basel process, particularly the Basel capital process, has really always been in the fundamental interest of the United States. Hal Scott mentioned that the very first Basel was because the Japanese banks were being allowed to operate with $12.73 of capital, and they were hoovering up all the business in the world, literally all the business in the world. Those of you with gray hair around here will remember the late 80s, and it was like US banks could not compete because the Japanese banks did not need to have any material amount of capital. And so the first Basel effort was to say, globally active banks will have globally consistent capital levels. Now that was, it was fair, it was crude and simple, but it was a first effort. Then during the 90s, the European banks were operating with much less capital than the American banks. And so Basel II was this complicated effort to create an intellectual framework that would justify allowing the US banks to lower their capital to the levels of the European banks. The math club went to Switzerland. It was extremely difficult to understand, but people felt confident at the end that the capital could come down. No sooner was that done than you had the great financial crisis. Whoops, wrong direction. Capital needs to come up instead of down. And Basel III has been ensuring that particularly the Europeans, but global capital levels in general, are consistent. If you don't like what's coming out of Basel, what I say to the folks who wear my political football jersey, who believe that we go into these fora and are snookered by the wily Europeans, it's like, that's not what happens at all. If you don't like what is coming out of Basel, it's because you don't like what the US took into Basel. We generally get everything we want out of Basel in order to create this level playing field. And if we didn't have Basel, we would all be subject to these same rules because that's what we took in. And the rest of the world would not. So I do think it's very important that following these principles of not increasing aggregate capital, doing it in a sane and smart way, getting a lot of input on the technicalities, that we do finish the implementation of Basel.
Well, thank you. Shira, do you want to weigh in on where you think the mistakes were in the past?
Sure. Thank you very much. And I agree with everything that my other panelists have said. I think it's important to take a step back in light of the history journey that Randy just took us on and recognize that what is attempting to be done in Basel III Endgame is what's transpired over the last 4 decades and 4 iterations of changes to the capital framework, in that it addresses every component of the risk-weighted asset calculation and the ratio construct themselves. So it's a significant book of work, and some could argue the most significant book of work. And in my mind, there were 2 flaws in the design of the original NPR, both of which relate to isolation. The proposal was done in isolation of the other components of the capital framework, and the proposal was done in isolation relative to what was being done internationally. So as it relates to the capital framework, what's unique with the United States relative to every other major jurisdiction around the globe is that the stress capital buffer is a Pillar 1 requirement, which means it's included in your capital ratio requirements. And therefore, when you're going to overlay Basel III Endgame with the stress capital buffer, you need to be extremely mindful of the capitalization included in each, affecting the same asset class or markets or products. And it didn't appear as though, based upon how the NPR was proposed, that that was done to a sufficient level. So that's one component of where it was done in isolation, and I think didn't calibrate correctly. The second is it was done in isolation relative to the rest of the world. And there are components that was included in the NPR that no other jurisdiction in the world implemented. So for example, the SFT minimum haircut floor was included in the NPR. No other jurisdiction has implemented it. The public listing requirement to get an investment grade rating was not implemented in any other major jurisdiction in the world. And so as a result, it's not surprising that 97% of the responders to the NPR were against it in some way, shape, or form. So the good news, and part of it is, the energy that you're feeling in this conference, is the Federal Reserve has the opportunity to repropose Basel III Endgame, and I agree with Randy's statements that it should be on the docket of the many things that Vice Chair Bowman needs to do. But the good news is Vice Chair Bowman specifically has discussed the importance of looking at capital holistically and the relationship between all the different components. And then from an international perspective, because most jurisdictions are further along in implementing Basel III Endgame, you know the answer as to what every jurisdiction around the world has done, and that can kind of start as the blueprint as to how the Federal Reserve wants to repropose.
Well, thank you for that. I think since it's entitled The Evolution of the Capital Framework, I want to know what would a successful Basel III Endgame final rule look like? I mean, how would we know if we'd succeeded in what we're
Okay, hopefully
attempting
that fixed
to
the
do here?
problem.
I'm happy to start and others can weigh in. Every time a new capital rule is put into place, whether it's in the US or internationally, what essentially is being balanced is safety and soundness versus growth, innovation, capital markets, et cetera. And so in theory, you're weighing, and the regulators are weighing those 2 things in making all of the decisions around capital implementation. And so to the extent that the only thing you care about is safety and soundness,
I mean, I took this trade because I saw the double bottom.
Capital,
and it just looked like it was just ready to go up. I mean, we could see.
But what would be the other side of that? Corporate bond underwriting would come to a screeching halt
but
because there would be nobody available to underwrite.
honestly, I might have to
hedge their
actually do
interest
it.
rate risk or their
I might actually
commodity
have to
risk or their FX risk. have
probably
no
take something
counterparties
off
that
at.
they can face. Mortgage lending, credit card lending, et cetera. And so it's really about striking that balance between economic growth and safety and soundness. And so when you look at the way in which most other jurisdictions have implemented Basel III Endgame, they've really tried to achieve that balance. And in some ways, it comes back to that capital neutrality point. And so there are certain components of the rule that they've implemented that incentivizes economic growth.
I know they're going to do it. I just don't want to take
Most
profits, man.
jurisdictions have exempted end users
This
from
thing
the
could run.
CVA add-on included in Basel III Endgame. And that's to protect those corporations from the burden of the banks carrying increased capital associated with facing them as a counterparty. many jurisdictions have not applied the 400% risk weight to public equity, to private equity, to all private equity, but limited it to speculative private equity so that banks can continue to participate in more mature private equity, which is often on the precipice.
And the
of then
Nasdaq
ultimately
and both the Nasdaq and the ES worked
so
really
to
hard to
me, a
freaking stop me out of
successful
this one.
Basel III endgame
If I was still, if so,
has appropriately balanced
I guess that's a
safety and
great,
soundness, which is obviously incredibly important, but also economic.
has definitely showed that.
Randy, do you have a view? What does success look like?
I think that was.
So I was looking for an entry at 130.
Pretty good overview.
I was looking for an
of what a
entry at
successful
130.
implementation would look like. You would the purpose of these last measures.
I would
is
have
to
only been in
create,
25 points of
incentives with respect to bank activity without
gotten my
increasing
scaling
the
target
capital
hit,
burden,
and I
if
would
you
have gotten my
will.
first
And I think
target
if you
hit.
see, bank activity modifying appropriately in light of the areas where these new capital requirements are being implemented in a way that is supportive of economic growth, but you actually see, okay, well, the banks are changing their, we have in fact created incentives. We're seeing that the incentives are operating appropriately, and we haven't increased the overall capital burden on the system. That's a success.
Phil?
Yeah, I mean, the best way for me to answer that is
testing.
is to couch it in terms of the way we tried to construct our own implementation of this. So
At my
I guess there were
equalizers right
three
now
things. So
on
one was from the
OBS.
bottom up, activity
Looking at my
by
equalizers.
activity. We weren't looking for too
Yeah, I
little
think it should be.
capital, but we weren't looking for too much either. So that a kind of fair amount of capital, if you like. And then top down, we had a view that there was enough capital in the system. So this wasn't meant to be about looking for more capital overall. And then third, we were looking for international consistency. So we were monitoring what other people, what other countries were doing. So what does a good one look like? I think it looks like
Get that
those things
recovery,
coming
man.
through. So the playing field looks level. We've got consistency across jurisdictions. We're looking to make sure that capital isn't rising. So one of the things we'll probably get onto this when we talk about stress testing, is we had a principle from the beginning that we shouldn't double count. So if there was something where we were holding capital previously in some part of the stack, and now Basel 3.1's coming in and you're holding it in Pillar 1, and it's the same thing, then you don't need to hold the capital twice. And that was a principle that we tried to build in from the bottom. It's easier said than done sometimes, so it's not always obvious what is a double count. Final thing I'd say, so I do think there's something in this for small firms. So the risk sensitivity that I mentioned, I think is a good thing for small firms on the standardized approach. And I'd like, so I think we'd be looking for in our implementation, just a bit of the leveling the playing field between small and large firms. That's it.
And most importantly, less loans to the shadows.
I think one of the things that, Randy, you just touched on was this idea that what happens if the U.S. doesn't complete Basel III Endgame, and there have been some lawmakers who are concerned about the international framework as if we're deferring to international regulators of what to do here. So let me just ask each of you, what happens if the U.S. just decides not to implement Basel III?
Because 130, so in my NA meetings, I was looking for, so actually let's look at that.
Yeah.
So I was actually looking
I
for.
guess the first thing to say is I hope that doesn't happen because
we got.
So
actually, I think all my levels got hit.
Get tremendous value from our close.
I was looking at 295. This one kind of front ran my level. I don't know why.
It really
it actually bounced instead of going all the way down to 295. It bounced at 297.
I guess a bit more
if I took that 295 entry,
I haven't really seen evidence of that.
With the 20,
that it's particularly likely. So my reading of the consensus is that it doesn't seem very likely. And I guess at one level, I don't find that surprising because in the way Randy and I have tried to describe the benefits of kind of being similar across jurisdictions.
So damn, it would have ticked me out and then jumped.
Financial stability. It
would have ticked me out and then jumped.
Leveling the playing field. And
But I was actually, so
these are all
if we
things that
broke
we recognize that
this
the US
range right here,
recognized when this
I was
was being
actually looking for
negotiated in the first
130.
place.
And the reason why I
So
was
I'd
looking for
argue that
130, 120
banks,
was
large US
because
banks as well as UK banks, benefit from that consistency. So you'd
so I
want
can try to
do
find it on
is,
the because
I
it was a
think is
previous
130.
range on the Nasdaq.
So
Let me
all of
see,
that explains
120,
why we're a long
130.
way down the track in terms of our implementation. But so, I mean, given those arguments, if the US really
Yeah,
didn't
right here.
implement, obviously that would be a major issue. And I think it would be wrong to
It's a
deny that it
previous
would be a
range right
major
here
issue. So although
that
I
I
think
was
there are
looking
strong
at.
drivers to get Basel Endgame done, we'd have to cross that bridge when we come to it. But I know US authorities that we speak to anyway understand that very
And
well.
then we also had that opening range right here.
Yeah, I was just going to kind of agree with my panelists. I think that although my perspective
If
is
I saw
obviously
that
different as
break,
a
I was looking for
practitioner,
130, but I guess at the time when I
importance
was
of having
talking
the
about
banks around
somebody
the
else's
world
business,
on a similar and consistent capital framework,
they
recognizing
got my
that it can be
scaled in.
gold-plated in some
I would have
jurisdictions versus
had
other, and on all things that need to be
literally 2
addressed
more
and
points of
discussed.
drawdown
But
before
I do think that it's important
this
that the
thing
U.S.
reversed,
implement Basel III
and I
Endgame
would have gotten
to
all
be
my targets
consistent
hit.
with the other banks
But I
around
do
the world.
think that ES is
Randy,
about to
anything
go
to
up,
add
though.
to what you said earlier?
I do think that we're about to
think
see
the-
ES go up a little
I
bit.
think the principal consequence would be when we get to Basel IV, which we will. There will be new issues in the future. That, we will learn things about the financial system will evolve, the banking system will evolve. There will be a need to evolve the capital framework in light of that. Other issues will arise, and we in the United States will once again say, if we want to have a fair playing field on which to compete, there are some changes we need to make, and we want them to be made consistently. And if we have not implemented Basel III, which was very much driven by the United States, we will walk into that room and people will be much less willing to listen to us, since we were the Lucy that pulled away the football the last time.
Mike, do you have anything you want to?
Get it done, get it done, get it done. If you don't, then the cost of capital for banks would be higher than it otherwise would be.
So I want to spend a little time. There's an entire panel about the stress test, and I don't want to steal their thunder, but I do want to talk a little bit about the interplay between Basel III Endgame and the stress tests and what the relationship should be. So Shira, let me start with you. What should the relationship be between this?
Sure. It's a great question, and it's something that gets a lot of discussion. As I mentioned earlier, the U.S. is unique in that the stress capital buffer is part of our Pillar 1 requirements or part of our ratio requirements, and therefore requires a higher degree of sophistication when combining that with Basel III Endgame, because you have everything that's been capitalized in the CCAR stress test, and then you have things that are being capitalized for in Basel III Endgame, many of whom are double counts across them. So in my mind, the most egregious example is operational risk. In the results that the Federal Reserve released last month on the CCAR stress test, they included $180 billion of capital associated with operational risk losses on the banks that participated. And so therefore, that $180 billion has been capitalized for in the bank's ratios. When included in Basel III Endgame, it reintroduces operational risk into the risk-weighted asset framework. Currently, today, that only sits in the advanced ratio, so it's not part of the standardized ratio, which is the more binding ratio for the banks. And so included in Basel III Endgame is operational risk-weighted assets. In the estimates that the banks provided in conjunction with the NPR, the amount of capital associated with those operational risk RWAs was around $150 billion. And for those that don't know, operational risk is capitalizing for, generally it's legal losses, that's kind of the biggest driver, but it includes any sorts of costs associated with outages, climate-related events, et cetera. It's all captured in there. So when you take the stress capital buffer loss of $180 billion, plus Basel III Endgame RWAs of operational risk, which is around $150 billion of capital. What the original proposal did is just put those two numbers on top of each other. And so the question that every constituent should ask is why is it necessary for banks to hold $180 billion plus $150 billion of capital associated with operational risk? And if you look at history and just focus on the GSIBs, over the last 10 years, so decade, the GSIBs, and I can only speak to legal losses because operational risk losses are not in the public domain. The GSIB legal losses has not been 180 billion. It's not been 150 billion. It's been less than 100 billion. And that's over 10 years. The CCAR stress test is only 9 quarters. And so I use that because, again, I think it is the most egregious example, but you can look at market risk, you can look at CVA, you can look at lots of different components. And the challenge for the Federal Reserve is to look at what's being capitalized for in the stress capital buffer, which is unique, and what's being capitalized for in Basel III Endgame, and making sure that they're not double counting things.
Randy, can you, the stress capital buffer was finalized under your watch at the Fed. Can you take us through why it's better than the CCB was and why it's needed now?
So I think that there are two parts to that answer. One is a legal part, sort of general legal principles part, and the other is a practical part. So before the stress capital buffer, and I hadn't realized this until I walked into, well, it wasn't this building, it was the one across the street, which now may never be built. But before the stress capital buffer, the outcome of the stress test, the practical outcome of the stress test, depended on what the Board of Governors had had for breakfast on the morning it was presented to them. And that does not seem to be the right way to operate a regulatory system that's going to have such consequences for the regulated. So the basic legal principle, it seemed to me, was that the consequences of the stress testing process should be clear and concrete and measurable. They should be legal as opposed to entirely discretionary. And I should state that I'm a big fan of stress testing. During the COVID event, the fact that we had stress tests and we ran 7 stress tests in the United States during that period allowed us to be very confident in the resilience of the banking system during that whole time, and allowed us to continue to allow our banks to pay out dividends when the rest of the world had suspended them. And our banks are benefiting from the lower cost of capital that comes from that predictability of return even today, many years later. So stress testing, good in general. But there should be a predictable outcome. The practical side of the question to me for the SCB as well is that if it depends on what you have for breakfast, different people at different times have different breakfasts. And the potential consequences of the same stress testing outcome, depending on the particular people who have been appointed to the Federal Reserve at any point in the future, could be dramatically different. If you've left that open, you've essentially left it open to the vagaries of the political process if you don't have a concrete consequence for the outcome of the stress test. Over a long period of time, the Fed is a marvelously apolitical institution. As a citizen, I've been very, very pleased with my involvement with it to see how true that is. But, but the people are appointed through a political process, and over a period of time, you could have significantly different outcomes for the industry. So I think both for general legal principles of regulatory action should be subject to discipline, and the stress capital buffer makes it clear what that discipline is.
Got the mute. So it has to be something with the
predictability,
something with the software
results over time.
For whatever reason, I can't seem to find an answer to my question.
That's how the outcome of the stress test should be implemented, is through some sort of a stress capital buffer.
Mark, you
Seem
look like
to
you have
not be able to
something you
find
want
the
to-
I just want
answer
to put
to
an
my
exclamation
question.
point for what
I've
Randy
muted the
said.
mic.
I
I've
mean,
unplugged the
stress-
mic,
having
and then
had the
that
stress
hissing
test
sound comes
in April
through
2020
the mic
or
or
spring of
aux.
2023. We felt confident. I think a lot of investors felt confident that
So it's not
banks
the
could
mic picking the
withstand
noise
whatever
up.
was coming
It's
their way. The largest
the noise
banks.
coming from somewhere. I don't know where the hell it's coming from.
If the agencies agree that the fundamental review of the trading book plus the GMS and the stress test hit bank trading books with excess aggregate capital requirements, what is the best path to reducing that surplus?
Honestly, when it comes to these board meetings,
Should we soften the GMS or look
there's
to
a bunch of
soften the
people that
FRTB
theorize and don't really know what the hell
domestically
they're
or in
talking
Basel?
about because they're not even They're not
Sherry, you wanna-
attached to
I'm
any
gonna- I'm
reality.
going to volunteer you because you have the red light on your microphone.
I heard FRTB and that's like magic.
These
to
are
my
people
ears,
that
so I
have nothing
figured-
else to do.
I figured it was coming my
They
way.
have no
My
real
takeaway
problems.
From Randy's,
God damn,
talk
that's
as to relates to how
God
the SCPs
damn.
arrived is that
I just
should have gone to
realized how
culinary
buff she
school,
is. God damn.
instead of becoming an accountant. Would have been better for Goldman Sachs.
Yo.
But with that said,
Used to be a fucking
the
bodybuilder.
FRTB, and for those that don't know, that stands for Fundamental Review of the Trading Book. That's the market risk
Yo, look how
component of
buff she
Basel
is,
III
yo. That's
Endgame.
crazy.
And the global market shock, or GMS, which is included in the CCAR stress test, is the instantaneous shock to the trading businesses of the largest banks. And so your question underlies the issue at hand, which is that there's a duplication between how FRTB is shocking market risk and capital and requiring capitalizing for market risk versus the GMS. And if you dig even deeper, they both kind of do it in a similar-ish framework. They're both looking at the same position set, and they're looking at tail risk. So they're shocking it to like the very tails in terms of how those markets would be
Ozempic
affected.
and steroid diet.
And then again, in the
Yo,
original
she is
proposal
big.
on Basel III Endgame, stacked those two things on top of each other. And so to your question, to the extent as the Federal Reserve is looking to repropose Basel III Endgame, as well as, all the work that's being done on the CCAR process, I think both stand to benefit from a really deep dive to ensuring that the shocks and the assumptions and liquidity horizons that are being used in them are consistent. And I'll use an example that I think highlights it. The GMS still uses assumptions from the financial crisis in terms of the level of shocks, despite how far we are removed from the financial crisis, and more importantly, how much reform has happened since the financial crisis. So as an example, using securitized product, so this is the underwriting and packaging of mortgage-related or asset-backed or CLOs, taking all those assets together and issuing them as bonds. The shocks that the Federal Reserve applies in the most
So this is
recent
kind of why
CCAR
I don't
stress
like
test, the one that
trading
we
the
just got the
ES.
results of, are equal to the shocks that banks, that those assets suffered during the financial crisis.
You always
What
kind of
that
have to
doesn't
wait
account
for something
is
to
the
happen
fact that the
before something happens with it.
LTVs of those loans are significantly different. The FICO scores of the borrowers are significantly improved.
And honestly,
And
I
so
really
the
don't even know
shocks
where
are
I'm at
being
on this
applied to
really don't know where
bonds
I'm at
and
on this chart
assets that are
with ES.
much better
I mean, I see this
underwritten or
range right
subject to
here
much
that the
better
market
underwriting
is trying to
relative to the
hold,
products that were being traded
but I
in
really
the
don't know
financial
where I'm at
crisis. And so I do think that the
on the chart.
GMS is very ripe for that, to get that overhaul, because it really hasn't been addressed, since it was first put in place. And one of the ways in which the calibration is off is to the extent that you take an asset, a securitized product, and subject it to both FRTB and the GMS. About 15% of the product that was underwritten last year, banks would be required to hold more capital than the carrying value of that asset. So I would have a bond with a carrying value of $100 million. And if I added FRTB and the GMS to it, I would capitalize that for $120 or $130. So the capital that I would hold is greater than the carrying value, such that if I wrote that bond down to zero, I'd actually release capital. And so it's an example of where you can look at it quite simply and see that the calibration is off. And as I mentioned, this isn't one or two bonds. This is 15% of the market that was underwritten last year.
So one of the arguments that Treasury Secretary Scott Bessent brought up last night was talking about whether or not firms should be able to opt in to Basel III Endgame, those that are not covered by it. And I guess I want to get the panel's view
Suffering over
are there
previous day
pros
low.
and cons
Yeah, on the
to
ES, yep.
including them versus not allowing them to be included
329 was
if they want to,
yesterday's low.
and what the system looks like?
I'm a libertarian. And I'm nobody's mother. I mean, if they want to opt in, I don't see a downside, except potentially from the institution, and that's theirs to judge.
Phil?
Yeah. So so this is a question about whether you apply the rules to the to small banks. So Basel 3.1 was agreed internationally, so clearly applies to the largest banks. I've argued that it's better than what we have now, so I think you'd want to apply it to mid-sized banks for us. The question is, do you apply it to the very smallest banks? So in the UK, we've long wanted to have a kind of a more proportionate regime for smaller banks, and now that we have left the EU and we can write our own rule book, we've been working on that. So we call it strong and simple, in homage to Mike. So we had to decide whether to take Pillar 1 from Basel 3.1 and give it to the very smallest banks. In the end, we decided we would because we just felt it was better. We felt it enabled them to compete more. The caveat was that where we saw that there were parts of the new Basel framework where they just didn't need the rules because they didn't do much of it, like trading book rules, CVA, counterparty credit risk, all of that kind of stuff. We said, you don't do much of that. That's how you got into the strong and simple regime, and so you don't need to worry about those rules. So we carved them out of that, but the rest of it we did. So we have. I think it is possible to give the Pillar 1 to smaller banks, and I do think they would benefit from it.
One of the things in my former life when I was editor at American Banker, we used to talk a lot about capital standards always inadvertently pushing banks out of different activities. So, can you talk about the extent to which there are dangers in Basel III Endgame of doing that versus, how can we morph capital requirements to bring some of the activities that were in the past possibly pushed out by these capital requirements back into the system?
I'm happy to start and others can weigh in. I think that your question is 100% right, and we've seen it time and time again. No matter how big or how small the rule is, as the capital framework continues to evolve, you're able to pretty clearly see the impact of what it does to the broader market as a result. So when, mortgage lending related requirements were gold-plated, you immediately thereafter saw an uptick in the amount of mortgages being underwritten outside of the banking system. Most recently in the implementation of SACR, which is the counterparty credit capitalization requirements, which is actually part of the Basel III Endgame, those rules changed the capitalization for short-dated derivative hedging. And as soon as that rule came into play, you started to see that activity move outside of the regulated banking system. And so that unintended consequence of the amount of activity kind of almost immediately responding. I mean, you even see it in CCAR shocks, where if in a particular year, the Federal Reserve shocks are more punitive to something specific from an asset class perspective, you will see banks will do less of that and it will move outside of the regulated banking system. And so that's something that needs to be really carefully thought about in conjunction with all the components of the capital framework that the Federal Reserve is looking at, whether it's the stress test or Basel III Endgame or GSIB, that to the extent that you're increasing the capital requirements on particular products for the most highly regulated banks, that activity will go somewhere and it will go out to the less transparent outside of the banking system.
Randy?
Yeah, I do think that is something that has heretofore across a broad range of eras and people and regimes been given insufficient attention in thinking about bank regulation. Is that especially in the United States, but now really even very substantially globally, it's a financial system. It's not just a banking system. And if we adopt regulations that are going to push something out of the banking system, it will go elsewhere. We will not really constrain that activity. You have to think, and we will push it into either parts of the financial system that are less transparent and less well capitalized, or jurisdictions that are less transparent and within the banking system that are less transparent and less well capitalized. So, and there really has not been sufficient attention, I think, given to that holistic view. You know, the growth of private credit in the first instance was really driven by regulation. I think it's now growing for reasons that are outside of regulation. I think actually there are reasons to think that the growth of private credit is probably stability enhancing because the vehicles through which private credit is provided are less subject to runs. And an ecosystem is developing where the banking system and the non-bank private credit system are working together in a way that allows more visibility from the bank regulators into the overall financial system. I think it's working well now, but there's the fact that it's working well, there's no particular reason to have driven it out of the banking system, and the bank regulators should think about, if a bank can do this lending safely, it should be allowed to do it safely, even though the private credit system is not, in fact, I think, harmful in any way.
Well, we have a brief few minutes before our panel ends, so I have more than enough questions that I can keep going, but trust me, question right up here in the front.
Thanks. I want to take us back to some of Mike's slides in the beginning, where you painted sort of a picture of utopia, a city on the hill that would be both strong but simple. So if you were going to try and move us from where we are today towards both simplicity and strength, are there one or two things you say these would be the best moves to get to that city, both for Mike and for others?
Well, I call it balls and strikes. I don't set policy. So I'll let you know once I see it. But when I talk about it being confusing, it's not just confusing to investors. I bet it's confusing to bank board of directors too, and bank execs, and frankly, probably some regulators. When I talk about it being constraining, let's banks be banks. When I talk about it being costly, I mean, that's an easy one. And we all see examples of that. But I think, two themes have come up. Certainly holistic approach to capital. Second is the idea of level playing field. But I'd add a third one, and that would be dynamic regulation. Because we're going to have more bank failures. There's going to be more bank crises. That we all know that, but they don't repeat, right? You had lending to South American countries, and then you had commercial real estate, and then you had long-term capital, and then you had global financial crisis, and then you had Silicon Valley, and the next one's going to be different. So I like the idea of having examiners also being accountable in a decentralized way, as opposed to ivory tower academic setting models. So I think a degree of humility about what we can do. And when I was here 35 years ago, there was Bill Taylor, who headed bank supervision regulation. He was the best. And he was like, be tough on the things that matter. That's capital, that's liquidity, that's what keeps you solvent. So that's my template for it, but I'll leave it to the ones who practice and do these things for the policy.
The good news is, we're having a conference like this, like we've never had before. And when you look at what Vice Chair Bowman's done over the course of the last few weeks, it's more change than we've kind of seen in both the recent past and even longer. I think focusing your question particularly around the CCAR stress test, we are pleased with what the Federal Reserve has done thus far in terms of enhancing some of the disclosure around the tests, and also talking about their willingness to put the scenarios and the models out for public comment, because we think that transparency is really important. As the firm with, I would argue, probably the most volatile stress capital buffer, I agree with Mike's points. You can imagine capital planning is very difficult when your requirements could change year over year by north of $10 billion, even though your business model is relatively consistent. And although the averaging NPR has been to address that volatility, it doesn't actually address the fundamental or the root cause of the problem. The root cause of the problem is the scenario and shocks, which we've talked about, that really haven't been calibrated for all of the regulatory reform, the Volcker rule that we talked about in the last panel, mandatory margin and clearing, and all of this uplift that's been done to the regulatory environment, such that the shocks that existed in the financial crisis shouldn't be the shocks applied today. And then the models, again, we don't have full transparency around them, although we look forward to that, don't respect some of the observed correlations that exist that we've seen it happen time and time again. Example around trading revenues. All the most recent crises have proven
Concern in
that
this
in times of volatility,
is that
trading
low right
revenues
there.
increase because there's more
That's my
activity
only
and
concern
bid-offer
in
spreads
this
widen.
long
Nevertheless, when the Federal Reserve
action
models trading revenues
at
in
that breaker
stress, they
structure,
don't include that assumption.
at that 200 EMA
And so I think that we're on
breaker structure.
a really great path, but that's some of the more particulars that need to get addressed.
But if we can get over that,
Jarrett,
we can definitely see price trade to the other side of that range.
Yeah, hi, Jared.
We can definitely
Seberg
see
with
that.
TD Cowen. I'm going to regret saying this on camera, but I actually agree with Mike that I think most of the market doesn't understand bank capital rules. And I think we run into a problem where there's such a push for tailoring. We hear that over and over on Capitol Hill. But that means that we have even more sets of rules, and we don't quite know which banks apply, are covered by which sets of capital rules. I wanted to focus in particularly on available for sale securities and whether those unrealized gains and losses should run through capital. I was hoping the panel could talk a little bit about why that's only for the biggest banks, and should it be pushed down to all banks?
Of course. I mean, I just hate.
That's a good question.
I just
Does
hate
anyone
missing the
wanna
move
jump
on the
in there
Nasdaq.
first?
Man. I just hate missing the move on the Nasdaq because it forces me to look at
So it's
the ES and gold, and
I probably shouldn't have pushed that button because it's been a
the points is going to come easier on the damn Nasdaq.
because it's been
If
a
you can
few
kinda
years
get in at
since
a
I
good
engaged
spot.
on the question. But it's harder than it sounds because to the extent that you push changes in the available for sale securities account through capital, then you create a strong incentive to move those securities to the hold to maturity account. And once they're put in the hold to maturity account, they are, as a practical matter, quite illiquid. So when the Federal Reserve, this was long before my time, this was under the St. Dan Tarullo's time, considered this question, that incentive was very important in saying, okay, well, we shouldn't do that for
The
most
Nasdaq
banks,
action,
in order
the
to
Nasdaq
create this kind of incentive for structural illiquidity on what should
at these lows right here, at their
of course,
or below,
the problem
you might get a
is
rejection
that
at
those
both of
available
them.
securities do change.
I mean, we're
in
already
value,
there on
and
the
that, can
ES.
have a capital effect. If you take, however, Silicon Valley
There.
Bank just as an example, where that was the most recent instance where this issue was considered, and people said, well, why shouldn't we have been requiring them to increase capital as the value of their securities was increasing? Actually, if you'd had such a rule, that would have created incentive for them to push much more of their available for sale securities into the hold to maturity account. And it was the fact that they had all of these securities in the hold to maturity account that was concerning, because they couldn't liquidate those, and it was that overall position that was causing the concern about their overall solvency. So you actually would have worsened the Silicon Valley situation, most likely, by creating that incentive for them to put even more of their liquid securities into hold to maturity. So, how do you address that? Well, you could say, all right, well, for banks, we're going to require you to take the changes in value of both of those accounts into account for your capital. But a long time ago, the bank regulators decided, I think on balance correctly, that the regulatory accounting regime had diverged so much from the generally accepted accounting principle accounting regime that it was now that there were a lot of pathologies associated with that, and that the bank regulators would rely mostly on the on FASB standards for determining what the what would be income, what would not be income. I think that's still correct. People have gone to FASB for a long time, even outside of the banking rules, to say that hold-to-maturity
I will say
securities
that
should
it's
be
kind of
treated
hard to tell
differently,
on
and they have
Bookmap.
decided not to.
It really is. It's kind of hard to tell
Again, because it's not
on
as
the
simple a
ES because
question
we
as it
could see a
sounds.
rejection
And
here,
so until they
but then we do have a lot of
I
orders.
think that, I think that that balance that's currently being struck about what to do with,
Got the order book.
accumulated other income or what to do
Yeah,
with
damn. God damn.
sale securities is
Oh man, I don't know. Oh damn.
Well, unfortunately, we
Damn.
are at time, but I want to please join me in giving a round of applause to
Damn.
these panelists. Thank you so much for being
Damn
here.
it. Damn.
Thanks again to the Fed.
On the ES. Damn. Cave trader, that wouldn't be a bad trade. Especially if the bulls fail here, that would not be a bad trade. What I don't want to do is move my stop up, get tagged out of this thing, and then it goes in the direction. Are you shorting the ES or are you taking that trade on the Nasdaq? Because it definitely the Nasdaq definitely still has more room for upside for sure. But I mean that can literally happen like in 2 seconds, so. Yeah. You say only on the ES or Pi? Well, I kind of got in late at this on this ES long, so I'm kind of asking the ES for a lot here. I know what's more likely to happen, but man, I would hate to close this thing and then it goes in my direction. I would hate to take profits on this and then it goes in my direction. Why would that need that? Bulls can recover from this, then we could see a breakout back into the range. I'll just be comfortable with this position. I'll be more comfortable with this position when we see that the range or that the be more comfortable when we close back within the opening range. And then the market will make its way and try to take out the highs. All right, so okay, so the meeting will resume after a break. On this board when he wasn't. I wonder what that was about. I feel a little bit better about it. As long as it can hold this area, as long as it breaks back above. But man, I don't know. There was 800 orders sitting here. Are you looking for the long, Santiago? Those updates. Okay. Well, I wish it would be nice if gold went back to ranging and breaking out instead of trending every damn day. It's like every leg is a trend leg. I only got a small piece of this. Only got a small piece of this move this morning, and this thing just shoots up an additional 14. Actually, never mind, because so I left 30 points on the table. Damn. Damn. Save some of that. All right, ES. Push it. So I am kind of asking for a lot there. But if you kind of look at so at that meeting, I don't know if he actually did or not. But he was on the calendar to speak at that meeting, but he wasn't on that board. It was She-Hulk on that board. Outside of that, we don't have, I mean, I guess the Treasury buyback announcement, we could see some, well, that's going to, because this is, actually, let me change the time zones because I don't want to deal with that. Eastern. Oh, okay, never mind. So he spoke at 7:30. Okay. Well, he spoke at 7:30. That's already happened. This has already happened. We have Bauman speaking at 12, which is in 2 hours, and Money Supply, which is also at 12. So what happened at 12 at 7:30? Did we get a reaction? So at 7:30, yeah, the market, I guess the market didn't care. As the Democratic Party tries to make it seem that people hate Trump, regardless of what the data shows, it seems that a lot of people that, I mean, well, I guess it is Trump's administration. So, of course, that's going to be the perception, at least for right now. It seems that Powell has lost a lot of popularity. Obviously, us traders, we don't care about none of that shit. there's a lot of people that lost a lot of money with Powell, but at least when it comes to trading, we just know that whenever Powell speaks, the market moves, and that's all we care about. We don't. It just seems that Powell has respect. He's being put in the light, saying that he's unwilling to cut rates, not because it's his job, but maybe how he feels about this current administration. I just saw something very interesting. I don't expect anything to come from it, but Trump has accused Obama of treason based on him being allegedly the ringleader behind the Russia hoax. And he was called out for that. But it seems like the Democratic Party, before this announcement even made it on the public stage, on the world stage, it just seems like the party is moving away from Obama. Even Michelle, for whatever reason, is going on like she's kind of stepping out, kind of like what Hillary Clinton did. Like she's going to probably be married to Obama publicly. They'll probably never get a divorce, but kind of like behind the scenes, they're kind of doing the same thing that Hillary and Bill did, where they still marry. Podcast, and for whatever reason, she chose to speak about Obama's flaws and not his strengths, which, as a wife, and people are looking, when you're outside, regardless of who you are, because we wouldn't care about Michelle if it wasn't for Obama, if she didn't have that Obama last name. But yeah, she went on this podcast and was speaking negatively, and then there was like divorce rumors and stuff like that, just stupid gossip, but it's just public perception. And right now, the public perception is that the party, it just seems like everybody is trying to move away from Obama. Don't know what he did behind the election. I don't know. Who knows? But that's what it appears to be. And I find that very interesting. So I'm interested to see what they'll do about that. But I don't expect them to do anything. I really don't expect them to do anything. Santiago says, did you take the long on the ES? And yeah, I do see that it's respecting it. That's why I'm going to stay in this position until I get a break of structure below previous day low. Then we got to remember that there's somebody right here with 800, or there's rejecting from. So we'll see if the Bulls hold this, man. We'll see. We do got a bunch of buying right here. I mean, you can see that people are buying this. I don't know. Just don't like the fact that I'm fighting against that breaker structure, 200 EMA. You got 800 sell contracts sitting at this area at 38. What I do like, though, is that, like Santiago said, is that we are holding up the previous day low. At least the 21 and the 50 is some. So, I mean, as long as they hold that, then I think we'll probably have some turbulence in this area. But if we can get a breakout, we can use the stops that are sitting above these highs as fuel to push this market higher. So I don't have the best entry whatsoever on this. I'm kind of not necessarily at the middle, but I'm kind of in the middle of this thing. but there is a breakout and the bulls are holding the pullback. It's just, will the market continue higher? That's the question. Because I mean, I was profitable in this trade, but I'm trying to go for a bigger trade. So I was profitable. I'm technically still profitable in this trade. The question is, will we see the market actually break out the range high during this session without price needing to pull back and stop me out? Yeah, I'm gonna wait. Yeah. But all right, guys, that's it for me. Gotta hop into this meeting. We'll definitely come back this evening, and peace out, everybody.